What if I told you that the final financial hours before the 1929 crash didn't feel like a crisis at all, but like a celebration? That the moment right before everything collapsed looked more like a victory parade than a warning sign? And what if the people who should have seen it coming didn't? Not because they were foolish, but because the system itself was blinding them? Picture this. It's late October 1929. Wall Street is glowing with an electric confidence that feels almost invincible. Brokers are leaning back in their chairs. Newspapers are bragging about record breaking highs. And everyday Americans, teachers, factory workers, cabinet makers, are pouring what little savings they have into stocks, convinced the market will rise forever. You may think that in a moment like this, people would sense danger. But here's the truth. Economic euphoria has a way of numbing the senses. It whispers that the rules have changed, that gravity no longer applies, that everyone from bankers to bellboys is about to get rich. But wait, that's not the whole story. Because beneath the parade, beneath the champagne, beneath the headlines promising a new era of prosperity, a quiet panic is already starting to crack through the floorboards. Not loud enough to hear, unless you know where to listen. Let's zoom in on one specific moment. October 23rd. The ticker tape is running hours behind, literally unable to keep up with the volume of trades. It's like watching a traffic jam form in slow motion. Brokers on the floor are squinting at the tape, frustrated, because they can't tell whether their clients are gaining fortunes or losing them. Imagine checking your bank app and seeing a 6-hour delay on your balance. That's how surreal it was. Yet, instead of interpreting the delay as a warning, the public reads it as excitement. So much trading, so much activity. This must be good. It's the same psychological trap we fall into today when we see a stock going wild online. Motion equals opportunity, until it doesn't. Now here's where the stakes rise. Behind closed doors, major bankers meet at the offices of the Morgan Bank. This isn't unusual. What's unusual is the tone. For weeks, they've been propping up the market, buying blue-chip stocks at inflated prices to calm investors. It's like using a credit card to pay off another credit card. Looks clean on the surface, but underneath, the debt is growing. One banker reportedly mutters something that sends a chill through the room. "We're running out of ammunition." And he's right. Their pool of money is shrinking by the day. Public confidence is the only thing keeping the market upright, like a bridge held together by faith instead of steel. But out on the street, you'd never know it. People are still signing up for margin accounts, borrowing money to buy more stock. Up to 80% borrowed. Think about that. Buying a $100 share with only $20 of your own cash. The rest? Debt. A house of cards, stacked on top of a windy hill. And yet the newspapers are still printing optimism. Experts are still smiling. Radio hosts are still calling it the greatest boom in American history. Even President Hoover says the economy is fundamentally sound. And in all fairness, from 10,000 feet, it does look sound. The factories are running, cars are selling, cities are growing. But underneath, consumer credit is stretched thin. Farm prices are collapsing, and wages aren't keeping up with production. If you've ever looked at a friend who seems successful on Instagram, but is drowning in quiet debt behind the scenes, that was America in 1929. Here's where everything becomes a tightrope. A single rumor, a single headline, a single panic-triggering spark could cause the whole structure to wobble. And in the final hours before the crash, those sparks begin to fly faster than anyone can contain them. The bankers feel it. The brokers feel it. Even some politicians feel it. But the average American? Still cheering, still buying, still believing. And then comes the moment no one expected. Because it doesn't start with a spectacular explosion, but with silence. A pause, a hesitation. stocks begin to dip. Not dramatically, not dangerously, just enough to make the floor tremble, like the first cracks in a glacier. And that hesitation, that tiny shift in mood, is about to trigger a chain reaction more powerful than anyone realizes. Leave a comment. What was the most important lesson for you so far? Because the next step is where the real unraveling begins. In those tense, late October hours, hesitation becomes the enemy. The market, once a roaring engine, starts coughing. A few investors quietly pull out. A few brokers make nervous phone calls. Nothing dramatic, yet. But in a system built on borrowed money, even a small tremor hits like a hammer. Think of it like this. If everyone in a crowded theater suddenly shifts one step toward the exit, it doesn't look like panic. But if one person trips, the entire room can turn chaotic in seconds. That's where Wall Street was, one stumble away from a stampede. On the morning of October 24th, known later as Black Thursday, that stumble arrives. The market opens, and for the first few minutes, the ticker tape scrolls normally, steady, routine. Then, a sudden surge of sell orders hits. It's not hundreds, it's thousands, like a dam cracking. Brokers start shouting over each other. Phone lines jam, clerks sprint across the floor. And still, the public doesn't know, because the ticker, still hopelessly behind, keeps pumping out old numbers, showing prices that no longer exist. Imagine watching a storm roll in through a live stream that's an hour delayed. You'd have no idea your house was already underwater. But inside the skyscrapers, panic is hatching. One banker sees the early numbers and freezes. He knows what this means. Panic selling spreads fast, and once it starts, stopping it is like trying to catch falling knives with bare hands. Yet here's the twist. The big banks don't give up. They rush into action. A handful of them pool around 25 million, an astronomical amount for the time, to buy up massive blocks of stock, hoping to steady the market. And for a moment, it works. The slide slows. Prices bounce a little. Newspapers that afternoon publish headlines like "Bankers Save the Day" and "Market Rally Underway." And for a brief moment, America breathes. People go home thinking the worst is over, that the grown-ups in the room have everything under control. But this is where the thunder hides behind the lightning, because the banker's rescue isn't a solution, it's a delay, a pause button, a temporary patch on a leaking submarine. Behind the headlines, the margins are burning. Regular investors, people who bought stocks with borrowed money, are getting margin calls. That means their brokers demand more cash immediately to cover losses, and when they can't pay, the brokers sell their stocks automatically. More selling, more pressure, more fear. It's a vicious cycle, and once it starts, it gains speed like a downhill boulder. Meanwhile, out in the heartland, farmers are already living in a slow-motion depression. Prices for wheat, cotton, and corn have been falling for years. Many had placed their hopes in the booming stock market, thinking it could offset the struggle, and now they're watching the floor disappear beneath their feet. Factories are booming, but wages haven't kept up. Consumers are buying everything on installment plans: radios, refrigerators, cars. The 1920s look prosperous on the surface, but underneath, the economy is stretched like an overinflated balloon. One more breath, and it pops. By the end of Black Thursday, a grim truth settles over Wall Street. The banker's intervention didn't restore confidence. It exposed how fragile confidence had become. When people require a heroic rescue just to stay calm, you already know the storm is far from over. But the most alarming sign comes after hours. Brokers gather in dim offices, staring at chalkboards full of red numbers. They've seen bad days before, but this feels different. It's not just a correction, it's not a blip. It's the beginning of something deeper. a simmering panic they can't talk about publicly without making it worse. One broker later recalls the eerie quiet after the closing bell. It felt, he says, like the moment before a ship sinks, when everyone pretends nothing is wrong, but the tilt under your feet tells the truth. And that truth is about to become undeniable. Because the next day, Friday, the market steadies. Not because investors feel confident, but because they feel tired, numb, shell-shocked. People want the weekend. They want to believe the danger has passed. But weekends don't heal financial wounds. They give them time to fester. And when the doors of Wall Street open again on Monday morning, the real collapse will begin. Because Black Thursday wasn't the crash. It was the warning shot, the final alarm, the last chance to recognize what was coming. And almost no one did. The next chapter isn't just about falling stock prices. It's about how a nation's identity, its optimism, its ambition, its belief in endless growth, can turn into its greatest vulnerability. And on October 28, 1929, that vulnerability becomes impossible to ignore. Monday morning, October 28th, arrives with the kind of chill that doesn't come from weather. It's the tremor of a nation about to realize that the rules of the game have changed. Before the markets even open, brokers are swamped with sell orders, far more than they can execute. That's the clue. That's the sign that confidence has finally cracked. When the opening bell rings, stocks don't just dip, they plunge. A cliff dive. By late morning, the Dow is down almost 13%. Imagine waking up to find your retirement account cut in half before lunch. That's how fast the bottom fell out. The floor erupts into controlled chaos. Phones ring nonstop. Runners sprint between desks. Brokers yell until their voices disappear. But underneath that fury is something more dangerous. Confusion. No one knows exactly how bad it is because the ticker tape is lagging again. Hours behind reality. It's like looking through a fogged windshield while your car skids downhill. And that's when the psychological collapse begins. People don't panic because they understand the numbers. They panic because they can't. Humans fear the unknown more than the unpleasant. And right now, the entire financial system is a black box. Outside the stock exchange, crowds gather on Wall Street. Thousands of people. Some hoping for news. Others just mesmerized by the idea that something historic is happening right in front of them. Police form lines to hold back the crowd. Reporters scribble notes. A few shaken investors walk out of the building looking like they've aged 10 years in a morning. And still, there are people who think it's temporary, that the market will find its footing again, that the bankers will step in one more time. After all, didn't they save the day just 4 days earlier? But this time is different. The bankers don't have the firepower. The scale of selling is too massive, too frantic. The market has become a runaway train, and all the levers that once slowed it down are failing. Meanwhile, regular Americans, the ones who trusted the boom, who invested on margin, who believed in the promise of easy wealth, start receiving phone calls with terrifying words. You must deposit additional funds or we will liquidate your position. Most can't. They don't have the money. So their stocks are sold automatically, accelerating the collapse. It's a perfect example of how debt amplifies a crisis. When things go up, debt feels harmless. When things go down, debt becomes gasoline. By the afternoon, brokers are exhausted, red-eyed, desperate. Some are pleading with clients, others are begging for instructions no one can give. A few simply slump in their chairs, staring at numbers they've never seen before. And out in the Midwest, out in the textile towns, in the mining camps, people are hearing rumors, not from radio or newspapers, but through word of mouth. The market's crashing. Businesses are in trouble. Banks might fail. Fear spreads faster than information. Factories start preparing emergency cutbacks. Stores reduce orders. Companies freeze hiring. The stock market is collapsing. But the economy is beginning to quiver too, and millions of Americans don't yet understand how connected those worlds are. By the time the market closes on Monday, the losses are staggering. But the most chilling part is this: Tuesday is coming. And if Monday was the earthquake, Tuesday will be the aftershock that destroys the building. Black Tuesday, October 29th. When the doors of the exchange open that morning, tens of thousands of people crowd the streets again. Some climb lampposts just to see what's happening. Journalists say the air feels like the moment before a verdict is read. Inside, the market collapses almost instantly. 16 million shares are traded, an all-time record. Prices fall so fast that brokers stop calling clients because there's no point. Shares worth $100 a month ago are selling for $10, then $5, then less. Fortunes evaporate in minutes. Some of America's biggest companies, U.S. Steel, General Electric, American Telephone and Telegraph, see their values sliced in half or worse. And remember all those ordinary Americans who bought on margin? Their accounts are wiped out. Savings gone. Dreams gone. Entire futures rewritten in a few hours. Yet here's the striking thing. Most Americans aren't in the stock market at all. Fewer than 3% own stocks. But the crash isn't about the market. It's about what the market signals. The illusion that prosperity is permanent has shattered. And once it shatters, every part of the economy starts bracing for impact. When the closing bell rings on Black Tuesday, the sound isn't just an ending. It's an omen, a warning that the crash is only the first wave. The Great Depression, the long, grinding, heartbreaking collapse, hasn't even started yet. But here's the question you should be asking. How did it get this bad? How did a booming, confident, innovative nation allow itself to walk straight into a disaster so massive it reshaped the 20th century? The answer lies not in the chaos of the crash itself, but in the years leading up to it. And that story reveals something uncomfortable about America's relationship with money, ambition, and risk. And it sets the stage for the final act. Continue with Part 4 when ready. To understand the final financial hours before the 1929 crash, you have to rewind. Not days, but years. Because the collapse wasn't a lightning bolt. It was a slow buildup of pressure that everyone saw, and almost no one understood. Throughout the 1920s, American prosperity looked unstoppable. Factories were modernizing. Cars were rolling off assembly lines at record speed. Radios and appliances turned homes into symbols of progress. It felt like a revolution, an economic one. And revolutions make people believe that the old limits no longer apply. But beneath this optimism were cracks widening month by month. First, wages. They didn't keep pace with production. Workers could buy more only because of an explosion in consumer credit. The buy now, pay later culture of the 1920s made the decade feel richer than it really was. But debt piles quietly, like snow on a roof. You don't notice the danger until it collapses. Second, inequality. A huge share of the nation's wealth flowed upward. The stock market boom wasn't driven just by faith. It was driven by a small, powerful class of investors and corporations steering rivers of money into speculation instead of investment in the real economy. When fortunes concentrate like that, the system becomes brittle. Third, the Federal Reserve. In the mid-1920s, it raised interest rates to cool speculation, then lowered them again, then tightened credit months before the crash. Mixed signals turned the financial world into a guessing game. It created the perfect environment for risky behavior, enough fuel to build the fire, then just enough oxygen removed to make it unstable. And finally, the stock market structure itself. Loose regulations, high leverage, rampant margin buying, and virtually no guardrails. The market was a skyscraper built with cheap materials, impressive from the street, fragile on the inside. So when the first cracks appeared in October 1929, The collapse wasn't merely possible, it was inevitable. Yet, even in those last hours, Americans believed they could beat gravity. That's the power of momentum. When everything is going right, people stop asking questions. Investors told themselves, this dip will bounce. Banks convinced themselves, confidence will hold. Politicians announced, the fundamentals are strong. But fundamentals can't save a system built on borrowed money and borrowed time. In the days after Black Tuesday, the shock spread. Companies cut jobs, banks tightened lending, farmers lost land, small businesses collapsed. The market didn't just fall, it pulled the entire country down with it. Still, the crash wasn't the end. It was the beginning, a turning point that forced America to rethink everything: regulation, banking, consumer protection, social safety nets. It sparked reforms that reshaped the financial landscape: deposit insurance, securities oversight, and stronger monetary tools. The lesson wasn't simply avoid speculation, it was something deeper. Prosperity without balance is temporary. Growth without guardrails is dangerous. And confidence without transparency is a ticking bomb. If the final hours before the 1929 crash teach anything, it's this: financial disasters don't come from surprise events. They come from ignored warnings, from optimism that turns into blindness, from systems stretched so tight that one spark, one rumor, one sell order, one panicked morning can bring the whole structure down. And here's the part that matters today. History doesn't repeat itself, but financial psychology does. Booms make us euphoric. Leverage makes us careless. And confidence makes us overlook the cracks forming beneath our feet. The people in 1929 weren't foolish. They were human. And humans in every era want to believe the good times will last forever. So what do we take from their story? That resilience comes not from avoiding risk, but from respecting it, watching for the cracks, asking the hard questions, and remembering that prosperity is strongest when it's built on reality, not illusion. If you found this story powerful, subscribe to receive more reviews like this. Deep dives into the moments that shaped our economy, our history, and our world.